Good day everyone. I'm Maria Angelica Sebastian, BSA 13, and today I will be discussing on how bank transaction and bank reconciliation works. Let's start. As a child, my parents taught me that saving will be beneficial for my future. Learning to save, I put it in my handy-dandy piggy bank. However, they also told me that piggy bank savings is not practical since it does not increase nor earn interest. Growing up, savings stored in the bank proves more money can be accumulated. As I become an adult, I was always curious on how bank transaction works for both parties. This is one of the main reasons why I chose this topic for my final output for the English subject. So, what does bank transaction mean? A bank transactions are defined as the record of all cash inflows and outflows of money in the account. All kinds of transactions such as withdrawal, checks, deposits will reflect in the bank statement of the consumer. But what does bank statement mean? A bank statement contains all types of information like bank account information such as account number. It is a document supplied by the bank and reflects the accounting records of the bank and not those of the business. Cash in, debit cash. According to the doubleentry.com, when a company receives their income, they will deposit it in a bank for security factors. The cash will be debited in their accounting records. Assets are on the left side of the accounting equation and cash is one of them. It owes the cash to the company and therefore has a liability. To show this liability, the bank will credit the account of the company and it will be shown as a credit in the bank statement. Cash out, credit cash. Likewise, when a business pays cash from its bank account, it will credit cash in its accounting records, which is a reduction to their assets. On the bank's perspective, it lessens the liability owed to the company and shown in the records. The bank will debit the account of the company, and this will reflect as debit in the bank statement. In summary to this, the cash transactions the bank shows on the bank statement will be equal and opposite to those shown in the accounting records of the business. Debits will go on the left side while the credits will go on the right side. They either will increase or decrease amounts depending on the type of account. For every transaction of credit must have a debit, and for every debit must have a credit. This is called a double entry bookkeeping in accounting terms. The debits and credits chart shown acts as a quick reference to show you the effects of debits and credits on an account. The chart shows the normal balance of the account type and the entry which increases or decreases that balance. In some transactions, error may occur. Errors are inevitable in a transaction revolving to two parties, the bank and the book or the owner. According to PC law, the definition of bank error is an incorrect credit or debit on the bank statement of a receipt and check that the bank may correct in the future. Since the correction will be done at a later date, an adjustment or reconciliation is required on the current bank statement. The last scenario was referred to as new error. Correcting the mistakes should be done as soon as possible to prevent spreading of confidential information and avoid unnecessary complaints to its consumer. Thus, this procedure, bank reconciliation, was born. Bank reconciliation is a must to prevent the overstatement or understatement of their money. What is a bank reconciliation? A bank reconciliation is a statement in which brings into agreement the cash balance per bank and the cash balance per book or accounting records of the company. The preparation of bank reconciliation is usually monthly because the bank provides the depositor a copy of the bank statement at the end of every month. When the depositor received the bank statement, attached there are the canceled checks and any other credit or debit memoranda that had affected the depositor's account. Correcting the errors and the reconciliation of the accounts are an important activity of the business, since it keeps the damages of the company into minimum. It also helps detect fraud and cash manipulation in the cash transactions of the company and the bank. Here are the references used in this PowerPoint presentation.
This has been Maria Angelica Sebastian, BSA 1-3, with the topic How does bank transaction and bank reconciliation works? Signing off. Bye.